Before we start today's show, I just wanted to mention our sponsor, Moneyfarm. Now, Moneyfarm is a leading digital wealth manager with over 60,000 active investors with over £2 billion invested on its platform. Now, it offers three main investment products, including a stocks and shares ISA, a general investment account, and a personal pension. By answering a few simple questions about your investment goals and attitude to risk, you'll be matched to one of the 7 globally diversified portfolios. Moneyfarm's expert team provides hands-on investment management by regularly adjusting and rebalancing your portfolio on your behalf. You'll even get a dedicated investment consultant should you want to widen your investment plan, which is something that sets Moneyfarm apart from most of its competitors. The minimum investment amount is £500 and fees range between 0.35% per annum and 0.75%, depending on the amount you have invested. Money to the Masses listeners can take advantage of a special offer where Moneyfarm will run your money fee-free for a year. Head over to moneytothemasses.com and search Moneyfarm for more information. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, in the last episode of Damien's Midweek Markets, I wrote about the optimism in markets ahead of a number of key events, with US equity markets aiming for new all-time highs. Now, much of that optimism was stemming from the unfolding earnings season, which continues to suggest that higher inflation pressures shouldn't necessarily hurt corporate earnings. Now, one of the potential hurdles that we had since the last time I did this show 2 weeks ago was the earnings reports from a host of US tech giants, including Facebook, which is now called Meta, Apple, and Alphabet, which is the parent company of Google. And of course, there was also Microsoft to think about as well. Now, last time I asked the question of whether we would see the tech-heavy NASDAQ 100 push to a new all-time high as a result of those impending earnings reports. And at that time, the NASDAQ 100 was sitting just below its all-time high, just below it by 1.5%. Now, to give you a sense of the strength of some of those tech giants' earnings, Alphabet exceeded analyst expectations with £53.62 billion worth in revenue, which was versus £52.62 billion, which was expected. And Microsoft was equally as impressive, and it posted $45.32 billion versus a projected $43.97 billion in revenue. And it means US equities were no longer just aiming for all-time highs. They were once again setting them. And in fact, last night we saw the 62nd and 39th all-time closing highs for the S&P 500 and the NASDAQ 100 in 2021, respectively. Now, this side of the pond, the FTSE 100 has sustained a month-long upward trajectory on the back of better than expected economic growth projections from the Office for Budget Responsibility. Now, the agency reassessed its growth forecast for 2022, now stating it expects the UK economy to return to pre-COVID levels by the new year, rather than the initial projections for March. It's meant that the FTSE 100 broke back above the 7,300 level, which it's the first time it's done that since February 2020 when the pandemic hit. And as you know, if you look at the global equity markets, UK equities have been a bit of a laggard. In slight contrast to the optimism in the US and the UK, European equities have been digesting disappointing earnings results from major players like Shell, Airbus and Volkswagen, which caused the pan-European stock 600 to lag its US and UK counterparts towards the end of October. But fast forward to this week, and the sole focus has been on the key central banks and whether they would raise interest rates and taper their QE programs. Now, the market expectation had been hawkish, or perhaps it could be more accurately described as fearing the worst but hoping for the best. Now, by the start of this week, we already had heard that the European Central Bank, that's the ECB for short, would keep interest rates unchanged despite ongoing threats from inflation, and the President, Christine Lagarde, further dampened expectations of a rate hike in the coming year. But then on Wednesday, the US Federal Reserve announced that interest rates would also remain unchanged over there for some time, but it would begin tapering its pandemic emergency QE program by $120 billion a month. Now, it meant that traders' bets of when US interest rates would rise were pushed into the future after what was deemed a more dovish than expected policy meeting. Now, this was enough to push the US S&P 500 and the Nasdaq 100 to new all-time record highs, as I mentioned earlier on. But not just that, we saw the broad indices for European stocks push to new all-time highs. And moments before recording this week's show, the Bank of England has announced that the MPC, which is the Monetary Policy Committee, had voted 7-2 to keep interest rates on hold at 0.1%, defying market expectations for an interest rate hike. Before this meeting, it was really the press had been saying there was a 50-50 chance of a rate hike. So the market had been surprised that the Bank of England didn't change anything, and actually they voted 7-2 to keep it the same. And even the governor, Andrew Bailey, was among those voting to keep the monetary policy unchanged. And of course, their QE target was left unchanged. Now, what this meant is the pound tumbled more than 1% against the dollar on the news, and that's obviously, as I said, in the last hour or so. Now, heading into this week's central bank meetings, the market was concerned that the ECB, the US Federal Reserve and the Bank of England would make policy mistakes by tightening monetary policy too soon in fear of rising inflation, but ultimately snuffing out the post-pandemic economic recovery. But right now, markets have been caught wrong-footed with their overly hawkish predictions being met with more dovish announcements from the three key central banks. It means the market is now concerned about each central bank's credibility in not only managing the balancing act of inflation and economic growth, but also in communicating its intentions. Now, while the decisions have at least initially, and it's only been a few hours since the Fed and the Bank of England have made their announcements, have initially been positive for equity markets, they have slightly pulled the rug from under bond markets, especially in the UK, where gilt yields fell more than 7%. It means that the 10-year UK gilt yield is back below that key 1% level, and that's all happened in a matter of minutes. Now, we've got to see how things pan out in the days and weeks ahead. But if you go over to the US, the 10-year US Treasury yield is back at 1.56%, having risen as high as 1.67% 2 weeks ago when I last recorded an episode of Damien's Midweek Markets. What it means is that equity markets continue to be taking a half-full view of the economic and investing backdrop rather than a half-empty one, and their resilience has well and truly been tested in the last week, and the markets have held up, and they're continuing, particularly in the US and even in Europe, to push to new highs, and we're even seeing that bleed over into UK equities. But the wild moves in bond markets mean that the gap between the volatility in equity markets and the volatility in bond markets is widening at its fastest pace in more than a decade, which some analysts cite as evidence of how complacent equity markets are about the risks posed by central banks that are ultimately beginning to tighten monetary policy, or at least talk about it. Now, if that is the case, then it could mean that we've got a day of reckoning coming our way with regard to equity markets at some point. But right now, investors continue to buy the dip, especially at the start of November, which also marks the start of the best 6-month period of the calendar year for stock markets. Now, 80/20 investor members will shortly be receiving a research piece discussing how you can take advantage of this phenomenon. But that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com. Twitter is money to the masses with the number 2. You can find us on Instagram, TikTok, Facebook, and of course, above all else, don't forget to subscribe to our YouTube channel.